Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. We got a lot of good things to talk about. Going to start off with, should you invest in gold for the long term? Gold has been so hot. You got to buy gold. Got to buy gold. Well, we're going to just give you some facts that are just like, oh, well, that's not that great. So I got to stay for that. Why is the government supporting universities with large endowments? That's another one that is just crazy. You're not going to believe it. I hope you sit down when you watch these numbers and hear these numbers. And lastly, could the trade war, could that hurt home prices? We'll talk about that, some surprising facts there as well. We dig deep for this stuff, and we give you some good information, and we got some companies, too, we dig deep on.
Yeah, companies we're going to take a close look at today. Netflix, I'm sure most listeners, viewers, they're aware of Netflix. Pretty good-sized company there. Yeah. I was going to look at Disney, Albertsons. Interesting kind of dynamic there between them and Kroger. And lastly, United Health. They had a huge falling out last week in terms of the stock price. We'll break down the fundamentals, give you an idea of the valuations, the balance sheet, and give you an opinion if we think it's a buy, sell, or hold based off of what we see here with those numbers. So excited to look at those.
All right, well, let's just dive right into should you invest in gold for the long term, because it has done very well this year. I think it's, up 20% year to date in a difficult market. I mean, the markets are down, stock markets are down, but gold, again, up around 20%. Now, when you look at the long-term results, and this is why we talk about long-term investing, they're not that exciting, and there are periods of time when gold has been a strong performer. But the thing is, when do these periods come up? When do you invest? When do you sell? It is like you need a crystal ball. We have one in our office, but you need a crystal ball that really works, because it's crazy.
Yeah, and I'm just kind of looking here. Year to date, it says on CNBC, it's about 23.8%. And I mean, you see the commercials. Had you invested in gold on this date and sold this date, you would have made a ton of money. And it's like, I mean,
pick the dates.
You could say, hey, had you invested in stocks on, I don't know what the exact, what was it, March 2009 or whatever? It's like, wow, you would have made so much money. I mean, you can kind of pick and choose. But the thing that we look at with gold for the long term, I mean, you go back to January 1980, and this is going back, you might be saying, well, this number doesn't sound that great, but gold reached $850 per ounce. And you're like, well, compared to, I'm kind of looking at the closing price here, $3,300 on Friday. I mean, that's pretty good, right?
Sounds great. Yeah.
Well, if you actually adjust for inflation, it's called a real kind of number there.
Real return, I think.
A real return, exactly. If you adjust for inflation, back in January 1980, the price of gold was $3,486 per ounce.
Well, that's the same price it is now.
Actually, lower. So, I mean,
you said 3,500.
Well, so no, right
What's the
now.
number again?
The number from 1980, the real number, again, the inflation-adjusted number.
Well, you say that's what it would be in today's dollars back then.
Exactly.
Right.
$3,486. Friday's close, $3,330. So we're actually back below that number, but we actually did surpass that. We did see gold hit $3,500 per ounce, which was an all-time high on an inflation-adjusted basis. But this means essentially you made no money in terms of a real basis, an inflation-adjusted return basis for over 45 years. So again, congratulations if you've held it the last year, but gosh, if you've held gold for the long term, I don't think you've done that well.
And you know what's funny, Chase, is that you talked about the real return, the inflation-adjusted return. Why do people buy gold? Oh, it's a great inflation hedge. Well, wait a minute. You've lost money with this inflation hedge.
I mean, it actually, maybe not. I mean, it's exactly an inflation hedge because you broke even with inflation. I mean, but that means if you look at when gold hadn't gone up, 20%, let's say, over the year-to-date basis, or, I mean, over the last year, it's done phenomenal as well. I mean, that then means that you were not even keeping pace with inflation had you bought it January 1980. And again, this is kind of picking a data point, but you go back 45 years there is no point in history, I don't think, where you could look at stocks on a particular basis like that and be like, oh, well, actually your return wasn't that good.
Right.
Even if you bought stocks in, 2007 before the big pullback, your returns were still better than what it has been in gold.
Yeah.
It's just something that it just doesn't make any sense to me.
I think gold is something that people just like the feel of. It's such an emotional buy. And again, at our firm, Wilson Asset Management, we say no emotions, just results. But gold is bought on emotions. It's bought on fear. It's bought on inflation, which we just proved doesn't really work very well. And you've got to time it. And there's no way to know. It's only based on what the next person will pay for it. And yeah, it's up now because of fear. But that could disappear very quickly, and all of a sudden, here you are again with no gains on gold. And this is why investors are such poor investors, is they chase returns. I think you said gold's up, 20% year to date? Wow, I better get some gold because it's going to keep going higher. That is not how you invest. You invest based on value. And with gold, what is the value? There's no earnings, there's no rent, there's nothing to it.
Yeah, there's nothing. So, it's a big concern. And then also, you're looking at just the price of it right now is what we're looking at. It doesn't even add the fact that there's additional expenses for trading and holding gold. Much more expensive than if you buy and hold good quality stocks or companies. Gold, far more expensive. So it doesn't make sense. I think it's a silly kind of tool that people sell as an asset allocation model. And I'd rather just buy good quality businesses for the long term. Gold, to me, it's too hard to value. It's like, oh, well, the central banks could be buying gold, so that's why you should buy gold now. And it's like, that's a guessing game.
Yeah.
What, even if, let's say, you're right and the central banks will start buying gold, what is the target sell price based off of that? You can't actually derive a fundamental value of what gold is worth. And that's why it's, I'm going to say, impossible to hold.
And you brought up a good point, too, about these selling commissions, because people don't think about that. And I know, and I've been wrong. I said at the beginning of the year, gold is pretty pricey. I wouldn't be buying it. Had you listened to me, you would have lost maybe about a 20% gain. But not really, because the commissions, I remember looking at that, they can be, I believe the numbers, anywhere from 4 to 10%. So if you're at $3,500, make it easy, and that's for 1 ounce, you're going to pay $350. Now, maybe they adjust it somehow, but the commissions going in are expensive, coming out. That's why maybe the ETF makes sense. There's just so many things. That's why we stay away from it. We did it one time. We didn't make a decent return on it, but we did it for inflation hedge during 2022, and it didn't keep pace with inflation at all.
And I've kind of gone back. I don't know if I'd ever do it again. I view gold as now almost a trading tool. Yeah. It's almost like an inverse correlation fund. And you might be saying, well, how does that relate? It's a trading tool. Right. And that's all it is in my viewpoint, because there's no fundamental value to it. So I think that's why I would stay away from gold. It's a guess at where it's going to go next.
Yeah. So that means we're saying do not buy it. If you hold gold, we're going to sell it. Doesn't mean it won't go to $3,500, $4,000. Who knows what craziness can happen. But again, keep in mind, since the last high of $850, inflation adjusted, you've actually lost money. That's the important part. So let's talk about why government is supporting universities with large endowments. And this is just blew my mind when I started reading into this, because I've heard the things about Harvard and so forth. So let me check into this. I did not realize that 658 institutions have about $874 billion in endowment funds. Now keep in mind, that's nearly $1 trillion they have in these endowment funds. Where is this money?
Where is it? Where's it going?
We're going to explain that, so be patient.
This also doesn't include the fact of the grants. And I didn't look into the grants. I don't think you looked into the grants either, but I know there's this big hoopla over Trump withholding $2.2 billion or something going to Harvard. And I'm like, wait, so they get a grant for $2.2 billion. They have this endowment that's huge. And then also, in addition to that, these universities that are, again, receiving money via grants, some pay little or no income tax, and they also get a waiver on property taxes. I'm like, I think we're in the wrong business.
I think we need to open a university, a smart investing university, because what deals they get, and it's just amazing to me what they get, and that cost of tuition, which I know we're going to go over as well. But I just want to bring up the number on these. And if you don't know, Harvard's endowment fund is $53 billion. That's an Ivy League school. Yale, $41 multi-billion-dollar endowment funds. We're going to show you where these come from here, but I mean, I mean, we could spend almost a whole show going over this, and we got to keep it somewhat short. But I mean, the tuition at Harvard is ridiculous as well.
I mean, tuition at Harvard is $57,000 per year. So you're thinking again, it's like, okay, well, essentially the way it should work in my mind is you should charge tuition, and then that tuition should be what the offset is to running the university.
Yeah.
But again, that doesn't appear the case. So I mean, a $57,000 tuition per year per student, I guess, doesn't go far enough at Harvard to cover everything. They need everything else. And I mean, maybe part of it is the administration of it. I mean, the president makes about $1.3 million a year. You compare that to San Diego State, here, a local university. My brother goes there. I have a lot of friends that went there. A lot of successful people I know went there as well. The salary of that president about $531,000, and the cost for 1 year of tuition is about $8,700. Is that kind of that from paying for Nash's tuition, or is
No,
that,
I actually looked that up.
You did look it up. Okay.
Online. Yeah.
So I just look at this, and I'm sure the students at Harvard, they do receive a more prestigious education. I mean, that the famous people from like the Federal Reserve, and there are more. I'm going to say this is no knock on professors at SDSU. It's just a fact of like people that were on the Fed many times go back to teach at Harvard, or there's more prestigious people there, so you can't deny that. But the question is it 6.5 times better, and do students that graduate from Harvard make a salary that's 600% more than a graduate from San Diego State University? I think that's a hard-pressed question.
Yeah, it is a hard-pressed question, and also too, I did look into, okay, where do these endowments distributions go from? I mean, where do they go when they got all this money? Where are they going from? So they fund about 48.1% fund student financial aid to help out with tuition. 17.7% goes to academic programs and research. And I'm not sure exactly. I know some universities do research. I'm not sure why. Shouldn't we leave that to the drug companies was my thought. Why are universities doing that? 10.8% is used for endowment faculty positions. And this is the one that I don't understand. Nearly 17% of the endowment funds are used for other purposes. Let me point out, that's almost a fifth of those endowment funds. They have no title for them. And I'm not sure where that money goes, but I mean, it's just, as you dig into this is, I don't want to use the word scam, but it's kind of like, who was that, the guy that got caught, not laundering money in New York. Not Jeffrey Bezos. No, what's his name?
Bernie Madoff?
Bernie Madoff, yes, that's what I'm saying. It's like, and he got,
Where's the money going?
Where's the money going? I don't get it. I mean, this is crazy.
Well, and I didn't have the numbers on it, and this is from ChatGPT. Harrison and I were actually looking at lunch the other day, and the number of administrators, based off what ChatGPT told me, so take that with what it is, but the number of administrators actually outweigh the number of undergraduate students at Harvard University.
Are you, really?
That's what ChatGPT told me.
So you got to repeat that, because I want to make sure people understand. So the number of administrators, and this is not faculty.
This is administrators
who do the office work.
Yeah, we'll call it.
They outnumber
the students, the undergraduate students.
There we go. We solved the problem. Fire half that staff, because they can't be working that hard if there's more of them than there are students. That's crazy.
And I point this out, obviously, because we're an investment show, but it's just like, what? It's just so interesting. I mean, this is kind of party talk, and it might get you in trouble, and maybe this gets in trouble with people a little bit, but I just don't understand it. You look at these numbers, it's like, what the heck?
Right.
But I mean, I'm going to pull this back in. We kind of went on this
rampage.
We're going to pull it back to the investment side here, because the other interesting thing about these is the investing philosophy. The goal is to earn around 8% per year for these endowments and pay out 4.5 to 5% to fund those various expenses. So they are using some of the money from the endowments to, again, fund those things as we discussed. This should then allow the endowment to continue growing, because obviously you're growing at 8, you're taking 4.5, 5. That should still leave some excess funds to grow. But a big problem is many have not been able to achieve that goal, with only 25% of 152 schools that were surveyed being able to meet the 8% return over the last 10 years. Over the last 10 years, stocks have done way more than 8% per year. It's like, what are you guys investing in? It makes no sense how these smart, intelligent people aren't even able to keep up with an 8% return. It blows my mind.
Yeah, and what are they investing in? Well, they can't cut expenses, because if there's a lack of grants, the grants or the government says, oh, we're not going to do this for you, so forth. The investments they're doing are not very liquid. Harvard, for example, 39% in private equity. So that means if you need the money tomorrow, like, oh, we need this because the government didn't give us this, well, sorry, you signed a contract. You can't get that until 2026. 32% in hedge funds, which also many times have contracts, can't cash out now, maybe next quarter, maybe only 10% of the fund or whatever it may be. 5% in real estate, which also is a non-liquid asset. 3% real assets, that's probably like your gold, your silver. That one is probably okay. And just 3% in cash. Where's the stocks here? I don't see any stocks.
Well, I mean, I was just kind of adding that up. I mean, if you look at 39 plus 32 plus 5, I mean, that's going to be about, what is that? That's about 37 plus 39. I mean, it's close
71.
to 80% essentially in those assets. I mean, it's like, what? And again, this is maybe one reason it hasn't kept up with stock returns because they're not investing in stocks. And it's like, why did you invest in stocks? And then the big problem is, as you said, it's like, okay, well, we lost funding from the federal government. As you said, it's like, okay, we have this $53 billion endowment. You can't even get maybe $2 billion out to pay for any shortfall because none of it's liquid. I mean, I can't believe this. I don't know. I'm very curious. How much do these managers make off of this as well?
I don't know. And we do our income account for clients. We do a 6% distribution rate, which has worked for well over 25 years. What are these guys doing? What are they getting paid? Where's the expenses? Again, I feel like there's a lot of one hand washing the other hand because we've talked about where the money's going and then what the managers are doing. And we bring this up because I always respected these guys. I mean, I thought, gee, these are the smartest guys in the room. I mean, they're from Harvard, they're from Yale, they're from Stanford. Wow. I don't know. Maybe there's something behind the scenes going on that, needs to be looked at.
I'm like, shoot, you could put, and this kind of gives a little bit away of how we do the income portfolio. And I'm not advocating you invest in the S&P 500, but shoot, you could have probably put like 90% in the S&P 500 and 10% in cash and be more liquid, and your returns would have been better. And even over a 20-year period now, I bet you, even if the S&P doesn't perform well over the next 10 years, which we don't think it will, I think that will still beat these
Jason, I got one better. They should have invested with Wilsey Asset Management. I mean, and our fee would have not been that high for that. For what do we charge for $1 billion? Oh, wait, we don't have an account with $1 billion. Let's move on to the trade wars about hurting home prices because I just want people to know. And again, we talk about too how the plumber is actually paying into the. I mean,
why is the plumber's taxes paying for Harvard's expenses? Yeah, when they make them. Charge all that tuition. Let's move on. Could the trade wars hurt home prices? Well, we're starting to see some cracks in the housing market. The FHA mortgages, and they do generally your higher risk mortgages, like low down payments, higher risk borrowers with lower credit scores. They're having some problems here that we're seeing that the delinquency rate is actually increasing on these lower end mortgages. Yeah, and I'm not going to say that the sky's falling and we need to be worried about this, but there's always going to be cause for concern. You can find any fact that's going to be troubling, but it doesn't mean it's not worth watching. And the delinquency rate for FHA currently stands at 11% according to the Mortgage Bankers Association, and it hasn't been at this level for 12 years. So again, I'm not going to be like, oh my gosh, we're going to have another 2008, 2009. It's terrible, but it is a little bit concerning.
It's something you want to look at because of the fact it is an indicator, and you want to start watching it and see. And what we talked about is that this has been caused by people stretching themselves too far financially. And we talked about this back 2-3 years ago. Where people, I got to buy a home, and doing the same thing they did with gold. Well, home prices went up 20%. I'm missing out. I've got to buy that home. And they would, scrimp and save, leverage, do whatever they could to get that home. And now there's some problems because they're not getting that growth as before. And I saw this back in 2006, 2007. I said, be careful. And I'm not predicting 2008, but I'm saying as a individual homeowner, as an investor, do not get yourself so tied up in debt to get into a home.
Yeah, and I think it is something that is a misconception. And I mean, I'll tell people, I bought a home here recently, and I'm going to tell you right now, I did not buy the home because I'm like, I'm going to make all this money off of it. I view buying that home, frankly, as an expense. I bought that because, I have a daughter and then another daughter on the way. And I'm like, I needed more space. I needed a little bit more of a yard for my daughter.
And you're going to have 5 kids, you said, right?
I mean, that's the plan. So I'm like, I needed more space, and it was just getting too hard. And especially renting, you're like, I can't really change things. So that's why I bought a home. I'm going to tell you, I don't even think my home will go up 10% a year or anything. I'm not like, wow, I'm going to make all this money. It's great. But I think that's where people kind of make a big mistake on it, in my viewpoint. And the thing that you look at, as you kind of said, is especially considering that home prices really appreciated very heavily in 2020, 2021. I think 2022 was okay, if I'm not mistaken, but really it was 2020, 2021 that you saw the big ones. But now people that have purchased the last couple of years, they haven't seen much of an increase in the equity of the home. So what that means is after fees and commissions, they may not have much, if any, equity built up in that home. So if they went to sell it, it could be a big problem.
Yeah, and that's a problem. And the other thing too, the builders are getting a little bit worried. I looked at the builders, and they've not seen this many homes sitting in lots with no buyers since 2009. And there's things that they can do, but these are just small things. And what we're trying to do is warn people from taking money out of your 401k for a down payment on your home because you're thinking you're going to do well. And we've unfortunately seen people do this, and then they don't have the 401k. The home is not doing very well. They moved to another state. I mean, it gets so complicated. You've got to slow down and think before you make an investment in anything, including a home. It doesn't always go up all the time.
Yeah, and I mean, kind of to that point with the home builders, is I was shocked by this number. I mean, I actually didn't see this until today, but the average incentives for home builders is usually around 5% of the total value of the home, but we are starting to see some incentives around 13% from big builders like Lennar. So, I mean, they're trying to push out that inventory because it's very costly for them to hold essentially a home that is not sold on the market.
Oh, yeah.
So it's much more beneficial for them to say, okay, well, we'll give you more incentives to get it off of our inventory books. Right. So, I mean, that to me is a little bit of a red flag of where we're at in terms of demand for homes. And actually, we saw existing home sales come out, and they were actually the slowest March pace since 2009. So, I mean, we are seeing some red flags. We are seeing inventory increase back up. We saw inventory rise by about 20% from March 2024. At the current sales pace, it's about a 4-month supply. I don't think we've seen that type of supply in years, frankly. Right. 6 months is considered balanced, so we aren't still quite there, but gosh, I mean, things are definitely changing a little bit, to say the least.
And then the last thing that's causing a problem in the home market is the volatility of the 10-year Treasury, because you're trying to lock in a rate. Well, the 10-year Treasury, which mortgages are kind of based off of, has been from 4.2 to 4.5, 4.6. So you start playing that game, and then you miss it. That's causing problems because people say, well, I'm just not going to do it. I'm going to wait till rates come down and stay down. So that's causing problems as well. So be careful if you're looking at buying a home. Again, as Chase did, you want a home to raise your family. You're going to be there for a long time, fine. But do not buy a home, and do not stretch yourself or leverage yourself so much that you have issues.
And I want to be clear with people, I don't foresee home prices falling 30%, where it's like, I've talked to people, I'm going to wait until home prices go down 30%, and then I'm going to buy. I'm like, I don't think that's happening.
Did you say 3 or 30?
30. Even 20%. I really think the base case that I have is just limited appreciation. I don't think you're going to have a big pullback. I just think it's going to be much more limited growth on home prices going forward.
And this all comes from our newsletter. If you want to subscribe to the newsletter, go to smartinvesting2000.com. Again, that's smartinvesting2000.com. We also have the newsletter history shows Apple stock performs poorly when margins decline. The world is fearful of recession. Trade deals with the U.S. are starting to blossom. Is the curtain closing on the Mag 7? So many important things there to help you become a smart investor. Smartinvesting2000.com goes out every Friday by email, 5 o'clock. Let's talk. You want to talk about Netflix?
What shows are on Netflix? Or
No, I think since it's an investment show, we got to talk. Yeah, and I go through spurts and so forth. I've not watched Netflix in probably about a month, and then I'll start watching it again. So many options. But let's look at the numbers of Netflix. Their symbol is NFLX in the entertainment energy. Not much short on that. 1.9%, 87% institutional owned. We do see, and I love Netflix, but still a high PE ratio of 52. But the industry of, again, entertainment has no PE, so no earnings there. Price to sales are expensive, 12 versus 2.5. Price to book value, 19.5 versus 3.4. Price to cash flow, 61 versus 18.8. And the PEG ratio looks okay. It's 1.5 versus 2.5. And they do have a lot of potential growth going forward is why things are so high. And they've had in the past, I mean, the earnings are up 46%. Over the last year, but the industry was up 118, which surprises me on that. Sales to Netflix do look very good, up 15%. The industry is only up 0.5%. The 5-year growth rate for Netflix is 28.2, double the industry at 14.7. So that's not a surprise. They don't pay a dividend. They've been around for a long time. They still don't want to pay out that dividend. I might want to look at the balance sheet to see what they got for cash there. Current ratio 1.2. That's below the industry at 1.9. You wouldn't want that higher. All the growth. Their debt still looks good. 0.6 versus 2.3. Net profit margin, wow, 23.1 versus a -1 for the industry. So that's very, very good to see that. Return on equity, 38.6 versus 17.3. The free cash flow in dollars was $7.4 billion versus about, looks like about 5.5 billion for the industry. What do you got going forward?
Yeah, so current price here for Netflix, again, their ticker symbol is NFLX, $1,101.53, 52-week range. I mean, the stock's been a huge performer. The low here, $544.25, and the high, $1,106.80. Actually did achieve that here on Friday. Going forward, though, I mean, this is the problem with Netflix. I mean, you kind of mentioned the overvaluation here in terms of what the multiple is.
Did you miss the 10-year return?
I didn't even give the 10-year return. What is that over the last 10 years? I mean, you got it. So
I got it. 1,279%. I mean, you've held it for 10 years. You got to pat yourself on the back.
Yeah. But the concern is over the next 10 years, what is it going to look like?
Yeah.
I mean, it's an intriguing story, and I don't know where that growth is coming from, but I mean, it's definitely expensive. I mean, you go out to December 2026, I see estimated earnings per share here of $30.82. Gives a target sell price of $511.61. It's trading at over 35 times those future earnings. But what I'm talking about with this future growth, and I don't know where it's coming from, is earnings are estimated to grow about 29% this year, 20% next year. So, I mean, the company is still growing, and I don't know if it's this ad tier that they've added where they've really been able to add additional income from that, additional sales, but there's something they're doing that, you know, they're running the business very, very well.
I mean, you got to say congratulations to this company because they have done a good job. I don't, like you, know where the growth is going to come from. I was taking a quick look at their balance sheet to see what they got in their cash account here. They've got about $8.3 billion. They've got a lot of cash, or cash flow is positive. It's just and I would love to own this company. I think it's a great business, but I can't pay this type of price for a company. We're a value investor. We do look at what you pay for something, and this always has come back eventually to hurt you when you overpay for something. Could it be tomorrow? Could it be next year? 5 years? I don't know. But, I mean, great company, very pricey.
Yeah, and I was going to say real quick, I mean, they did a great job. They topped earnings. I mean, they topped cash flow, topped sales. They did also say that they're expecting to hit a $1 trillion market cap by 2030 and double revenue. I don't know how a company says we're going to double the market cap to $1 trillion. I'm going to say a ballsy estimate there.
That's really ballsy. So, all right, wrapped up the first half. When we come back, we're going to talk about financial planning, Harrison Johnson, about pre-tax return accounts. Maybe a mistake to move to Roth. We'll talk about that. So stay with us. We'll be right back. All righty. Welcome back to the Smart Investing Show. This is the part where we talk about financial planning. We talk with our financial planner, CFP Harrison Johnson. And today we're talking about why converting all of your pre-tax retirement account to a Roth might be a big mistake. And that is something that I've seen people, they just don't do. They just, like we're just talking about people buying houses, all these crazy things people do. They need a good financial planner. Harrison, why should they not be doing this?
Well, you know, everyone likes the idea of tax-free retirement income. A lot of people like the ideas of Roth accounts or Roth conversions, but it's important to remember when you're putting money into a Roth account, specifically from a pre-tax account, there is a cost to it. And whenever you convert money from a tax-deferred account like a traditional IRA or 401k or whatever it is into a Roth, the amount that you move over is income, and it's taxed at ordinary income rates. Now, that's not necessarily a bad thing, but in the sense of, you know, trying to move over 100% of your money, what that means is to move it over, you're going to pay taxes on it. And then if you have no pre-tax money left after that, you're probably going to be in a much lower tax bracket, especially if your remaining retirement income is Social Security or a little bit of pension income. So in other words, you might get to a point where you have really no tax liability at all, which means you paid taxes to convert money just to be at a point where you were in a 0% tax bracket. It's much more efficient to try and keep your taxable income consistently low through withdrawals or conversions or, you know, whatever it is. And that's how you're going to increase your after-tax retirement income.
Before you came with us many years ago, I would look at people doing that, and I would look at the break-even point. Like, okay, so you're going to pay these taxes. When does it break even for you? Do you do that for people, saying, okay, this is why you can't do too much, you should only do this amount? How do you come up with a formula of what they should do?
That's part of it. The part to keep in mind is when you have money in a traditional IRA or a 401k or any pre-tax account, the thing to keep in mind is the amount of money in there is deferred income. It will be taxed. It's just a matter of when. When you are contributing to one of those accounts, you're not really getting a tax deduction. What you're doing is you're deferring your income to be taxed at some point in the future. So that's the way to think about it. You have this deferred income in this pre-tax account. It is your choice when to withdraw that and when to pay taxes on it. Now, keep in mind, when you get into your mid-70s, you have to take your required distributions, which all of those distributions from those pre-tax accounts are taxable. They can push you into higher tax brackets. They can trigger IRMA. They can cause problems like that. So there is going to be income from those accounts. And so when we look at doing conversions, it's what is the tax rate now that we can do that conversion at versus if we do not do the conversion, what tax rate will you be at later on in retirement or in your 70s or 80s or 90s? And if we don't do the conversions now, if the remaining required distributions will push you into a higher tax bracket, then it likely makes sense to do the conversion. So for a lot of people, that might be, at the start of retirement in their 60s, they do conversions all the way through their mid-70s. If you can convert at a 12% rate, for example, now, and then avoid a 22, 24, 25, 32% tax bracket in the future, then it's going to make sense. You're winning on the delta. But by doing 100% of all the money over, you don't want to pay 22%, 24% now to get to a 0% tax bracket in the future. It'd be much more efficient to try and stay, for example, consistently in the 12% bracket all the way throughout your retirement.
Yeah, I know it's something that people just kind of do willy-nilly, and it's like, I kind of going back to what you initially said, is like, it doesn't sound bad, right? You get to a point where there's no tax liability, but I mean, the big thing that I think is so important for people to understand is the fact that, as you said, why would you pay tax at 12% to then maybe pay tax at 0% 5 years from now? That makes no sense at all. The math on that, I know the kids nowadays say the math's not math, And I can say that now. I'm older, I guess. The kids nowadays.
That's right. The youngins. Yeah. Again, it comes down to, the way that tax brackets work is the first chunk of income is taxed at one rate. When your income goes above that, it's taxed a little bit higher. So of your total taxable income, it's taxed in chunks. So ultimately, if you can keep your income in consistently the lowest tax brackets, that's how you're going to have a higher level of taxable income. And another thing to kind of compare it to is it's almost like paying down a low interest rate mortgage. So for example, there's a lot of people that out there that were able to refinance when rates were low. Maybe you've got a 30-year mortgage at 3%. Well, you could pay it down really quickly if you wanted to. And what's that going to do? It's going to reduce your lifetime interest on that loan. But what is the cost of doing that? You're taking assets or resources from some other account or some other source that maybe that money would be better left there if it's earning more than 3% just to save on the interest. So the same thing with Roth conversions. People like, getting to the point of tax-free income, but they're not looking at, well, what is the cost? What are the resources that you're using now and at what tax rate to get to that point? That's why for every person, there is an efficient path to go through that, and it comes out to trying to keep things consistently low over time.
Well, Harrison, this is why people need a good fee-based financial planner, not a commission financial planner, a good fee-based financial planner that gets paid a fee off of doing the right things as opposed to selling products. So thank you very much for being here today, and great information as usual on being careful how much to convert to the tax-free Roth IRA.
Absolutely. Thanks, guys.
All right, you're welcome. All right, that is again Harrison Johnson. He's a CFP with a Wilsey Asset Management. If you want to talk to him directly, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Chase, you ready to hit some more companies here?
Let's do it. Yeah, I'm excited about this next one. So let's get to it.
Well, why you'd be excited about this one? Because return on Netflix was much higher than this one. We're talking about Disney, by the way.
I think there might be more opportunity with
There
Disney.
we go.
We'll see.
There we go. Well, let's see here. Let's take a look at Disney. Walt Disney actually is the name of the company. They're simple as DIS. They too, like Netflix in the entertainment industry, they only have 1.2% shares short on the float side, which just surprises me with what the stock has done. Thought it'd be higher. 71% ownership in the institutional side. More people, individuals, hold Disney than Netflix. Kind of surprised there as well. PE ratio, not great. It's better than Netflix, but it's 29.3. Industry, again, is non-material. Price of sales looks good, though. 1.8 versus 2.5. Price to book value, 1.6 versus 3.4. Price to cash flow is 11 versus 18.8. And the PEG ratio, 2.3, just slightly under the industry at 2.5. And I do believe, if I remember, Netflix did have a better PEG ratio.
I think they did. I think the growth is supposed to be better there.
Okay. Well, look at the earnings growth for Disney. It is up over last year, 234.8%. The industry was 118.5. Sales for Disney only up 3.7% versus 0.5. The 5-year earnings per share growth rate from the analysts only shows 7.3. That is half of the industry. I remember Netflix was twice the industry. Disney does pay a dividend, not very much, 1.1%. Look at the balance sheet. Current ratio, a little bit discerning here, 0.7% versus 1.9 for the industry. That's about a bottom or like a current ratio because they could have liquidity problems. Debt to equity does look good, 0.4 versus 2.3. We do see a net profit margin of 6.1. That's very good compared to a industry loss of 1%. Return on equity is 5.5. Return on invested capital, 5.2. They do have more free cash flow than Netflix. It was $8.4 billion, which is higher than Netflix, which does surprise me.
Yeah, that's interesting. I would have thought Netflix would have been higher, and I think that as well because I looked at these numbers, and you'll be shocked by this, but the current market cap for Disney, $163 billion, we'll call it.
Right.
And you guess what Netflix's is?
Trillion? I don't know.
No, not
that high. I don't know.
It's close to 500 billion though.
500 billion.
So I mean, we'll call it 3-4 times as big as Disney here is. Right. That blows me away considering Disney obviously has the theme parks, the cruise lines. I mean, they have a lot of strong assets.
And the studio.
The studio, yeah.
Yeah, Netflix does not have a studio, do they?
No, I mean, Netflix is definitely what I would call asset light. You know, I mean, that's why they have, I think, such great earnings growth potentially is because they don't have as many assets to maintain. Obviously, maintaining the theme parks is not cheap for Disney. But, I mean, that's still an asset that I would assume is valuable. You know, I mean, that thing is not taking away from the value of Disney at the end of the day.
One thing we could see maybe down the road where Disney does spin off the theme parks because I think they're very profitable and they are having difficulty with the entertainment side, it seems.
It's something that they call a sum of the parts equation where, you get to a point where maybe you just have the Disney Plus, which is the streaming component of it. They also have Hulu, ESPN Plus, so maybe they have that streaming component, and then you add in, the theme parks maybe become their own company, and then the sum of the parts where you take those two now separate stocks together is worth more than Disney by itself right now because it's like maybe the theme parks is weighing down the valuation of the streaming component. So, I mean, I don't know. I'm going to give the numbers here on Disney, but there could be some interest here. And I say that because the current price for Disney is $90.28. The stock is, I'm going to say, been a terrible performer. I mean, the 52-week range, $80.10 is the low. The high here, $118.63. Over the last year, Disney's actually down about 20%. Year to date, the stock down again about 19%. And this is where I kind of got surprised. 5-year return, negative 15%.
And I gave the 10-year return for Netflix was what, 12?
Like 1,000% or something?
I think it was like 1,200.
10-year return for Disney? Yeah, go ahead.
Minus 10%.
Yeah, you got 10%. The price return, because it doesn't include the dividend, but Disney really cut their dividend anyways. The price return over the last 10 years down 19%.
Wow.
So definitely not been a good performer there for the last 10 years if you've held Disney stock. But going forward to September 2026, I see estimated earnings per share of $6.07. It actually gives us a target sell price of $100.76. That plays in the hold categories. It doesn't give us that 30% margin of safety, but I think this could be one with all this volatility we're getting. I mean, maybe there comes an opportunity where Disney finally becomes priced for a appealing opportunity to us. Because for years we've looked at, I feel like Disney is like, just too expensive. And the target sell price has consistently been below the current price.
Right.
I think this is the first time I can remember in years that we've looked at Disney and I'm like, wow, the target sell price is actually above where it's trading at.
So are you saying that it could be on our buy recommendation maybe?
I mean, it'd have to fall further, or earnings would have to go up because, as I said, the target sell is $100 essentially. The current price is $90, so the estimated gain about 10%. But I mean, we're getting a lot of volatility right here in the market. I mean, you could get a pullback.
Right.
Obviously, things have been kind of crazy here in the markets where Disney could finally be an opportunity that, again, we haven't seen for years. Right. And it's kind of funny because for 10 years, that stock's done nothing. But again, it feels like 10 years. I remember we look at it almost every year because it's such a loved company by many people. Yeah. It's like, I wouldn't buy Disney, too expensive. I wouldn't buy Disney, too expensive. And now it's like, I mean, if I held Disney, I don't know if I'd sell it. You know?
And I don't understand, like with Netflix, because again, Disney has the theme parks. And by the way, I guess next weekend, the Marvel comics, they have a new movie coming out.
Interesting.
And I forget the name, but I saw like, I want to go see that at the movie theater, which I've not done in a while. But that's the other thing too. They have these themes like the Marvel comics. They've got other ones I can't think off the top of my head. Netflix doesn't really have that. They have these short-term bursts of names, but then they go away. They don't have any long-term, names like Marvel Comics and some of these other ones that are.
I mean, Disney's got the Disney princesses. They got that whole franchise there. I mean, they have that nostalgic asset that I don't think is going to go away for many, many years. So, I mean, there's definitely some intrigue here, I would say. As I said, it's still a little bit overpriced. It's in the hold category. It wouldn't quite be a buy for us. But, I mean, earnings go up a little bit. Estimated earnings, I should say, goes up a little bit. Stock price pulls back. Could be an opportunity there. And I was going to say, I think it's interesting, though. The thing that got me intrigued at looking at it today was there's a report by Wolf Research, and they upgraded Disney. As I said, it's priced like the sky is falling. I wouldn't go that far considering it's still trading at about 14, 15 times those future earnings, but it's definitely not priced for perfection like a lot of the other companies out there.
And to let people know that we like to buy a company, invest in the company around 12 times forward earnings. We like things on sale, not just like, and again, just said, price like the sky is falling.
Yeah, that's a little extreme.
Maybe he wanted to say that just to get in the public eye. I don't know, but
maybe. And I don't want people to get confused. I sound like I'm very excited over Disney here, but I think it's intriguing just because we've looked at it for so long. And as I said, this is the first time I can remember in years where we're like, actually, the sell price is above the buy price, or the current price, I should say. So interesting.
You want to talk about grocery stores?
Yeah, talk about exciting.
Yeah. Well, we went from Netflix, Disney to a grocery store. But again, grocery stores, I think, they're going to be around, whether it's going to be delivery. I mean, I see a lot more when I pull up to the grocery store, for delivery only pickup and stuff. So they are keeping up with the times. But we're talking about Albertsons companies. I think they own Safeway and Bonds. Yeah, they and the Albertson name. Symbol ACI, then the grocery store industry, 4% float on the short side, no problem there. Nice PE ratio compared to the entertainment companies, 13.5. Nothing for the industry there. Price to sales, 0.2. That's very good. Price to book value, 3.8. That is above the industry at 2.8. Price to cash flow, this is a phenomenal number compared to the industry, 4.8. Almost 1/10 of the industry at 41.9. And the PEG ratio, very good, 1.4 versus 6.9. Now, for some reason, it could be with all the potential acquisitions, mergers that they've been going through the last year, their earnings are down 26.5% when the industry is up 11.4. And I want to know why. I was going to buy Albertsons. Why? That seems out of line. Sales are up 1.5%, while the industry was down 0.7%. 5-year earnings per share growth rate from the analysts, 8% versus 8.3. That is fine. They pay a pretty decent dividend, 2.7%, and only use about 31% of their earnings to pay that out, so I'm very comfortable with that. Taking a look at the balance sheet here, they got a current ratio of 0.9 versus 1 for the industry, and that's okay. Debt to equity looks strange, 4.2 versus 1.6. I'm wondering if they took on debt to do these acquisitions. They're going to try Kroger's, was it? I forget who.
No, it was that Kroger was going to buy them.
By them. Oh, well, that could have been good for Albertsons with all that debt. I'll take a look at the balance sheet when you're looking at your numbers. But 4.2 is very high debt to equity. We do see a net profit margin 1.2, industry 1.9. Again, grocery stores do have a very thin profit margin, but a lot of turnover is what they get, a lot of sales there. Return on equity, that's why you look at return on equity, 28.3 versus 14.8. Free cash flow number, not very good, 749 million versus 2.2 billion for the industry. So I'm getting a little bit nervous here. What do you got?
Yeah, well, current price here for Albertsons companies, it's $21.91. The 52-week range, stock's actually done, I'm going to say, okay. And I was curious about this because I did see it go across the ticker tape, but Kroger's like right near an all-time high.
Yeah.
So I think people kind of are happy maybe that Kroger didn't buy Albertsons because that stock's been performing phenomenally. I'm curious how Albertsons is doing. But 1 year return, it's up about 10%. Year to date, it's done, again, okay, up about 10% given all the volatility. But going forward for Albertsons, we go out to February 2027. They report on a fiscal basis, $2.24. Gives us a target sell price here at $37.18. I mean, that's quite attractive. A forward PE multiple around 10 times. As you said, we like to buy companies around 12 times earnings.
Right.
So at 10 times, I mean, that's attractive. As you said, the big problem here, that balance sheet, I know you had that, but I did want to say of intrigue here, a reason Albertsons was interesting was the grocery store actually dropped about 8%. The stock did after they issued full year guidance that was below expectations. Company estimates adjusted earnings between $2.03 and $2.16. Analysts were looking for $2.28. So I'm curious why that business is maybe struggling a little bit more than potentially other grocers out there.
And just on the balance sheet real quick, cash, only have $294 million of cash here. Let me scroll down a little bit because I want to look at the debt. Where's the debt? Long-term debt, $13.4 billion. And that seems like it's been that way for a while. So I don't know why they carry so much debt. Their equity is only $3.4 billion. So they're really upside down here.
Well, and remember, obviously they bought Safeway, and Safeway owned Vons. So, I mean, there's kind of been this trickle-down effect, essentially, of maybe all this debt getting compiled by all these acquisitions. And Albertsons was private for years. Yeah. And then they became public again, I think it was just a couple years ago. So, I mean, the stock journey for Albertsons has been quite intriguing. And I'm going to say, while some of the numbers look interesting here, I just don't think you can buy it. I think that debt is such a burden. And you talk about Walmart, you talk about Costco, you talk about Amazon wanting to get more into groceries. I think this would be an interesting company if the debt was cleaner. But if you are wrong and Albertsons struggles further against those competitors, I mean, this company goes bankrupt because they can't keep up with that debt burden.
You know, and even going back to 2021, even back then, they had debt of $13.4 billion. So it's about the same. It did dip a little bit in 2022, but then it went right back up again. So these grocery stores, that's one thing I don't like. At least this one. We should maybe next week look at Kroger, but I don't like companies that carry a lot of debt because if things go the wrong direction, you still got to pay the interest on that debt. And that can cause problems to where now you have to start using your liquidity, then you can't pay the interest on your bonds. All of a sudden, you're forced into bankruptcy.
Yeah, and I don't know either how this, I'm going to call it MAHA, the Make America Healthy Again movement from,
MAHA. What is that?
MAHA.
It sounds like something from the Caribbean or something.
No, from RFK Jr. I'm curious how that impacts an Albertsons. And I say that because, like my wife, she likes to shop at Sprouts. She likes to shop at Jimbo's. She doesn't love to go to an Albertsons. She likes to kind of shop at those organic, healthier places. And I don't know if that movement, is that going to impact an Albertsons grocery store? I know they carry some of the, healthier alternatives, but is it easier to go shopping at the other locations if you are involved in that kind of movement, I'm going to call it?
And I kind of want to, RFK's been kind of quiet. I haven't heard much about it.
I mean, the only thing I did see is they are pushing to, again, remove those red food dyes from the big companies there. So, I mean, there's been kind of small things kind of percolating out there. So, we'll have to see, and we'll see if that movement carries on. But if it was an issue, I mean, the GLP-1s, is that going to impact an Albertsons? Because are people going to need to buy less food? There's some questions I would have about this company in relation to kind of the health of our country and those obesity drugs, which again are definitely growing a little bit more in prevalence.
And to let people know, this is the type of company that we do like.
Yeah.
But we like to have low debt, and we like to pay a reasonable price for it, which unfortunately that's not here.
Yeah, and the reason we like these types of companies is because they do kind of go against the grain, obviously. But if you're wrong on a value stock, you want to make sure that the balance sheet is okay enough that you're not going to lose everything. Because if you buy a company because of the valuations and then your thesis is wrong, let's say, and they have a terrible balance sheet, well, now maybe you didn't take a 20% hit on the stock. You lost everything because the company went bankrupt.
Exactly. That's why we give you these numbers, and and again, we do this live. We don't pre-look at the numbers before we come on the air. We actually look at them live. So we don't know what we're going to see until we see it. So you're getting our initial reaction of what we'd actually do here. So let's talk about a company that did get beaten up pretty bad. I think you're going to talk more about that, but we're talking about United Health. Their symbol is UNH. They're in the healthcare plans industry. Not much float here on the short side, 1.2, 91% institutional owned. So institutions love the stock, but individual investors don't seem to. PE ratio looks okay now, 17.5 versus 18.2. Price of sales 1. Double the industry at 0.5. Remember, you want these valuation ratios lower, not higher. Price of book value 3.8 versus 2.4. Price of cash flow 13.6 versus 13.1. And the PEG ratio looking very good. It's a 1 versus 4.9. And that one you do want lower than the industry. Their earnings were down 5.3% over the past year, but the industry was down 8%. So even though they're down, they did better than the industry did. Sales, they were up 5.5%, not quite as good as the industry, up 7.1%. Wow, the 5-year growth rate, I'm wondering if this is going to decline after you talk about what you have there, but the 5-year earnings per share growth estimate going forward from the analysts is 15.2. That's about 3 times the industry of 5.5. That holds. That's a pretty good indicator to maybe look at this company. They do pay a 2% dividend, use 52% of their earnings to pay that out. Taking a look at the balance sheet, current ratio 0.8, but that's normal for the industry at 0.6. Debt to equity 0.8, that is the same as the industry. One thing surprising to me, they have a lot of intangible assets, 44% intangible assets. That's pretty high for
likely acquisitions, I would presume.
Yeah, I guess so. But I'm kind of surprised by that. Net profit margin 3.6, above the industry at 2.2. Return on equity is 15.6. We like that number above 15, which it is, and return on invested capital of 10.8. We like that above 10. So there's some good things here. What do you got?
Yeah, and I was going to say, too, on the intangible side, the one thing that's interesting about United Health Group is you compare it against I'm going to look at Cigna, for example. Cigna is pretty prevalent in just kind of health insurance and the PBM side. I mean, United Health, they're kind of in more Medicare. They're in the health group plans. They're in the PBM side. Then they're also in like kind of doctors networks. I mean, they are, I'm going to say, more of a diversified health group than some of the other insurers, which maybe is one of the reasons they've carried a higher premium. But I mean, this pullback is, kind of intriguing here. I mean, the current price for United Health Group is $418.64. 52-week range, they hit a low on Friday at $412.02 and the high $630.73. Wow. Year to date, the stock's down about 17%. And actually, last week after they reported earnings, the stock fell about 22%. Those earnings were quite concerning, I'd say. The adjusted earnings of $7.20 on revenue of $109.58 was short of the $7.29 in earnings per share and $111.6 billion that analysts were looking for. They also did slash their full-year guidance. So, I mean, there were some big concerns in that report. Obviously, you're going to have big concerns to have a 22% pullback, but that has caused United Health to trade at levels not seen since October 2021. But going forward for the stock, I mean, is there opportunity here? I'm going to say maybe. And the reason I say that is December 2026 estimated earnings per share $30.95 gives you a target sell price of $513.77. That's an estimated return about 23%. So we just need a little bit more of a pullback to hit that 30% margin of safety that we look for to buy companies.
And Chase, I look at the analysts going back 90 days. They have reduced their earnings by about 7.2%. So maybe be a little more patient to see if more comes down. But I think there could be something here. but I believe a lot of the problem was with the Medicare side, correct?
Yeah, I mean, Medicare has been a challenging business, I know, and also too, a lot of that stemming from the medical care ratio. So they're paying out more for medical care than they're collecting in premiums. That's what the medical care ratio looks at. And from what I've read and just kind of loosely here is that a lot of these seniors that delayed, kind of elective surgeries for years are now going back to get those elective surgeries done. So it's kind of generating this pipeline. And United Health is having to pay out for that, which is costing them more money and costing that medical care ratio and spiking that level, which generally investors don't like to see. But to me, that's a short-term concern and could create some potential interest in buying a stock like United Health if it does fall further.
Yeah, and it's very hard in the industry because we don't know what changes are going to come up with Medicare, Medicaid as well, I think, for the states. I mean, and we've seen things. I think you had a quick... Got to save your quick story for next time. There's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purpose only, and it should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, give myself a call or Chase a call at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You can sign up for the newsletter there. Right in the middle of the page, you'll see the newsletter. Sign up right there at smartinvesting2000.com. And a lot of good information there. So look there and stay with us. We'll be back next week.